Let's do it, folks. Good morning. Welcome to the Street Today here from Post 35 on the floor of the New York Stock Exchange. Today is Monday, the 23rd of January. I'm JD Durkin. We are just about 1 hour into the trading session to kick off the week that will be. Stocks in the green here, about an hour and change or so into things as investors come off the worst week so far of 2023. Though the major averages are still up for the year itself. We've got a mega week of earnings coming up, including a few of the top names in defense, chip production, and EVs. In fact, roughly half of the market weight of the S&P 500 itself is set to report earnings this week alone. On the show this morning, let's take a look for what's on tap. We will talk Fed as investors continue to digest comments from officials, trying to read the tea leaves all around. Oh, they said this, but they said it that way. What could that mean? Plus, we'll preview it. That's basically how it goes. Plus, we'll be previewing a big earnings week ahead with names like Tesla, Microsoft, and Boeing all set to release quarterly results. And finally, we will continue our conversation on job cuts as Spotify becomes the latest tech company to announce layoffs. For more on those stories and so much more on this Monday, we now welcome in Mr. Martin Baccardax. He is our senior markets correspondent, our senior blueberry bagel correspondent. And are you a fan of Mondays? Are you like Garfield the cat, like I like lasagna, not Mondays? Or are you ready to get going and hit the ground running on Mondays? I feel like you are. You're a morning guy.
Feel a little bit more energized when Monday comes around, but they're blending into the weekend now, aren't they? I mean, with prep work that you need to do on Sunday evening and the whole bit, the days are just commingling, as it were, to steal a phrase from FTX.
I was going to say a commingling of funds, a commingling of work energies to kick off the weekend, my friend. I like it. Yeah. All right, so we're going to take a look at the week ahead here, but leaving earnings to the side, just to talk about some of the other factors at play. Markets here snapping a two-week winning streak last week, as stocks losing a little bit of momentum for their January rally, finishing in the green on Friday, but we had that, pretty brutal sell-off earlier in the week, Martin. What is the state of play looking like to you as we kick things off on this Monday morning?
It was a little bit firmer this morning, JD. I don't want to make too much of it just yet because it's only just begun, but the 4,000 point mark was reclaimed this morning by the S&P 500, and that was a technical level that the market had been basically bumping its head against for a number of weeks now. Once it got past that, we added 30 or 40 points very quickly. So if we are able to hold that gain throughout the session and perhaps into the early part of the week, then that could mark a significant change in where investors see the next technical breach, both as a floor and a ceiling. But again, it is early doors, and I don't want to make a great deal of it. But nonetheless, I do think that number is important if it can be held for a couple of sessions. Of course, we're going to face that earnings test nonetheless. But I do think we are seeing now just an incrementally positive view of stock valuations, and set against the assumption, even though it's still largely 50-50, that the U.S. could avoid recession this year. So if you have that mix of perceptibly cheap stocks set against an economy that won't slide into recession, then you have at least some mechanics for a sustained rally. And I think you add the tailwind of some late commentary from the Fed heading into its quiet period, and that's why you're seeing certainly firmer gains this morning than I expected, but decent gains nonetheless.
Any big economic indicators to watch, you think, for the week, or other little data points that might not directly tie into earnings that still might be pretty important?
Certainly, I think the Friday inflation numbers will be critical. That will be the PCE price index. It's the Fed's preferred inflation measure. And the assumption is that the core reading, which the Fed pays the most attention to, is going to echo the decline in headline CPI that we saw earlier this month for the month of December. So if all of that is trending in the right direction, it should be replicated in the PCE data. And if so, that will certainly put the market on firmer footing heading into next week's Fed meeting in Washington. It will begin on the 31st with an announcement on the 1st. If there is a surprise to the upside, then that could render some of the changes that we're seeing in expectation sort of null and void. But at the moment, I don't think there's any anticipation of a great surprise. I think ultimately the surprise will be whether or not inflation slows more than anticipated. But there's always a bit of a wild card because the PCE is a very different measure to the CPI, and that's a big part of the reason that the Fed pays attention to it. We'll also get a look at fourth quarter GDP, some PMI data, And I am going to continually look at what we are expecting from the housing market, particularly from mortgage rates, because I want to see if they are being influenced by the market's anticipation of slower rate hikes going forward, because the housing market is about to find a bottom, I think. And if mortgage rates could come down, that would certainly be a bit of an accelerant there. So I would say beyond earnings, those are the focus points, with really the market teeing up that PCE data at 8:30 on Friday morning.
Yeah, finally last week we did get that 30-year mortgage rate falling below 7%. I think it went from 7.08 to 6.15. Doesn't sound like a lot, but that was the fastest 10-week drop that we've had going all the way back to January '09. Could be a bit of a boost, but between the housing supply, there's so many challenges in that space. So I'm thankful that you mentioned that. You and I like to talk about the GDP Now metric from the Atlanta Fed. Gives a current reading. Correct me if I'm wrong. 3.5%. Does that sound right? Because it's sort
Yes,
of
I think
it's a
the
real-time
three and
barometer,
a half
right?
to 3.3, I think, is somewhere in the region. I think the expectation for the fourth quarter reading is going to be somewhere around 2.9. But all of those are going to change as data comes through to solidify our understanding of the final month of the year. And again, for the most part, it is backward-looking data, but it will nonetheless give us a sense of what momentum is being carried into the first quarter. And of course, the stronger the better. But we'll have to look at business inventories and see if they're piling up, and as a result, that might be as an expectation of either weakening demand or maybe just a mismanagement of supply chains. So there'll be a lot to pick through. We won't necessarily get the clearest picture from the first reading, but going forward, again, the best understanding that we'll be able to extract from these numbers is the momentum carried into the start of this year.
And you said your expectations for Q4 2022. We talked about it a little bit last week, and we are expecting that number later this week. You said you're expecting 2.9?
2.9%, yes. Yeah, that's the early
And you
indication,
said,
but we'll see where it comes in.
right. Now, usually that's I think a good comparison is kind of like it's like our body temperature, right? 98.6. I think that's supposed to be I'm not a doctor, but I think that's supposed to be our body temperature, right? We don't want it too far below that. We don't want it too far above it. That's like the Goldilocks zone. So 2 to 3% is usually the Goldilocks zone. But correct me if I'm wrong, Martin, though, Fed officials have said we actually don't want to be hitting that number, right? You said weaker is better. I may have misheard you in your last response.
Oh, no, I wouldn't necessarily say that the Fed is looking for weaker. I mean, ultimately, they need to understand how these numbers are affecting the labor market and ultimately price stability, because that is their twin mandate. Ultimately, you are going to see some echo of a stronger economy reverberate into those two components. But it can be very misleading because, again, it's calculated in a way that doesn't necessarily reflect sort of what's happening now, or in the Fed's concern, what is likely to happen over the coming months. And GDP fortunes can change very, very quickly, as we witnessed not only during the pandemic, but in the early part of this year, when there was a very intense conversation about whether we had slipped into recession. And then, of course, we had this roaring comeback in the second half of last year. So the Fed will look at it certainly very closely for its internal components, but I wouldn't necessarily say they're fixated either way on whether that number comes in at 2.5%, 2.9%, or even a touch over 3. Their focus is going to remain on what we are seeing in prices, price stability, and ultimately in their employment mandate as well.
Absolutely. Now, last week, Fed Governor Christopher Waller said he supports a 0.25 percentage point in 0.25, 25 bips in February, becoming the latest, or really the highest ranking member to say so publicly. How certain are we that it is going to be 25, you think, from February? I know I ask you this question every few days, but listen, for people who watch the show, the weekend may go by and they say, okay, has anything changed, Martin? I don't know.
Yeah, it's nearly 100% now, JD. I think the last time I saw it was around 99.3, 99.5, something like that. I think Waller coming on board with the smaller hike in February was sort of the final nail in the 50 basis point coffin. Not to say that anybody really had any significant bets in that direction. There was some reporting over the weekend from the Wall Street Journal, which has gotten it right the past few meetings, that says the Fed is ready to transition to these more traditional rate hikes or rate moves in general as a result of their confidence that inflation is very slowly moving in the right direction. That was sort of echoed by Christopher Waller's comments late Friday as well. And previously, he had been sort of one of the more vocal members of the FOMC pushing for higher rates. I wouldn't have necessarily described him as a hawk, but certainly in the conditions that he was witnessing last year, he felt those 75 basis point increases were absolutely justified. So to see him change tone and for that to be essentially the last message that the market is going to receive as we head into this quiet period, I think is absolutely important, and it is being played out in the CME Group's Fed Watch. Curiously, whilst it was being played out in the dollar and bond yields in overnight trading, they have reversed course a little bit. Now, I wouldn't say that that's any buyer's remorse or sort of second thought from U.S. traders. Here, I think what they are paying attention to, JD, is some dovish comments out of Europe, which is challenging the hawkish consensus there. And as a result, it weakens the euro, and that lifts a little bit anyway the US dollar, and it has this almost like sort of a gravitational pull to short and midterm bond yields. So that's kind of what we're seeing this morning. But I think essentially we are absolutely solidifying the case for 25 in February, another 25 in March, and then that May meeting will prove, I think, to be absolutely crucial, because the Fed will either go to its 5% plus rate, which it's been speaking about for most of the year, or it will hold at that 4.75% rate and essentially execute the pivot that markets have been expecting.
Absolutely. It's funny, whenever I hear the word pivot, I laugh, because we always just talk about this presidential pivot down in D.C. during the Trump administration. Like, oh, there'll be a very presidential pivot coming. Now the word pivot is just, it stands for something else, but doesn't mean I don't have flashbacks to my old career as a political reporter.
I'm not surprised.
Okay, so
that would have been traumatizing.
We talked about the dollar index. Yeah, for sure. So we talked about the dollar index there a little bit, or the strength of the dollar. But before we move on to anything earnings specific, is there anything else in the overall environment you would want to address before a big week coming up, Martin?
No, I think, JD, we've hit the high notes. What I guess I would say, or sort of caution for those who are looking at the markets first thing in the morning, is we are, of course, looking at most Asian markets are going to be closed for the bulk of the week, apart from those in Japan, as a result of Lunar New Year celebrations. So we won't necessarily get an overnight guide with the same sort of clarity that we typically do. But of course, it will be also interesting to see what headlines are emanating from China as a result of the lunar holidays, and if there's a deep acceleration in COVID infections. Health officials say they're comfortable with either the herd immunity or the vaccination rate there, and as a result, they don't see infections spreading any further, even though we are now starting to see a tick up quite significantly in overall fatalities. But the number of journeys that are going to be taken over this sort of 7-day period is just astronomical. It's in the 2 to 3 billion range. So the chances of an acceleration of infection is absolutely real, and we will have to monitor that coming out of the lunar celebrations at the end of the week to understand what implications it has for China.
Absolutely. Okay, with an eye now to the week that will be for the world of earnings here. Pretty busy one. I kind of want to do this day by day if we can. So tomorrow, Tuesday, I think these are all right. We'll hear from Microsoft, 3M, GE, J&J, a few of the defense names like Raytheon, Lockheed Martin. Any of those top names that I just mentioned there for you Tuesday?
Yes, I think all of those are coming Tuesday as I know it as well, JD, with Microsoft after the bell and everyone else essentially coming very first thing in the morning. I think Johnson & Johnson was always interesting. We'll understand what they have to say about the sale of COVID vaccinations, and maybe we'll get a little bit more update into their spin-off plans as well. GE will essentially give us the final quarter of numbers with their healthcare unit still embedded inside. It, of course, floated earlier this year, and it's a standalone entity. So that will be interesting as well. 3M is a good indication of what we're seeing in the industrial space, so obviously important. But Microsoft's numbers after the close of trading are absolutely the most crucial. They, of course, have executed those job cuts last week. There's been all sorts of questions about what they're seeing for business investment demand, not only for the 365 sort of Office division, but for the Azure cloud as well. And they made a big investment, or at least the indication of a big investment this morning into OpenAI, which is the developer of that ChatGPT chatbot that everybody's talking about. So we might get a little bit more commentary about what I wouldn't describe as a pivot, but certainly an intensification in artificial intelligence investment from Microsoft, and what this means in terms of challenging Google. So lots to pull from the numbers tomorrow, absolutely.
It's like day by day we see different headlines about the incredible things that ChatGPT can do. I think at this point, ChatGPT can run for a seat in the House of Representatives and probably win. Stranger things have happened.
I read somewhere, I don't know the veracity of the headline, but it suggested that ChatGPT was able to pass one of the examinations of the Wharton School of Business at the University of Pennsylvania.
Right. Yeah, if so, a far better standardized test taker than I certainly was, or likely still am. With an eye towards Wednesday now in earnings, Tesla, Boeing, IBM, those are three big ones. I mean, some days you rattle off a few and you're like, all right, some are more important than others, but I feel like those are three big guys, right?
Yeah, absolutely. Tesla and IBM after the bell, Boeing in the morning. What I'm always interested in with respect to Boeing is free cash flow. It tends to be a very important component to that story, and what they have to say about their order book and how it is developing, and indeed potentially what they're seeing from China, which is an increasingly, at least potentially important aspect of their future business model, because of course China has a need to upgrade the fleets around the world's biggest aircraft market. Boeing is locked head to head in competition with Airbus in order to get the bulk of those. The 737 MAX, which had been grounded by Chinese authorities in 2019, is only just back into the skies a few weeks ago, and that should open discussions for further orders from China aviators. So we'll look to that with interest. Again, after the bell, IBM, almost always a revenue story, but we'll be interested to see what they're saying with respect to cloud demand. And Tesla, of course, will be the granddaddy of them all. Lots to pull through there. What it seems, JD, now is that the conversation is very much going to be focused on how these recent price cuts will impact demand and whether they will be a net positive for the company. The stock is certainly on a bit of a roaring comeback. Analysts seem to have come around as well. Many more buy ratings out there. The stock may have bottomed out in that nadir period of December of 2022. But ultimately, we have to see what it does on a headline basis in terms of earnings and indeed revenues. And I think now with price cuts, JD, what's going to be more important are automotive margins. So there's going to be plenty to read about from that story, both going into the number Wednesday and coming back out on Thursday morning.
And finally, to the point about Thursday, Visa, many of the big airlines will be interesting to listen to, like Southwest and American. Also, Intel as well. We talk chips a lot. Anything big for you on that Friday Eve slate of earnings a few days out?
Yeah, Intel is always fascinating. That comes after the bell. They have been disappointing in the past couple of releases with respect to their near-term outlook, but I am seeing, obviously, I say obviously, it'll be obvious when we talk about it a little bit later, but analysts are starting to come around on the chip sector, and that might provide a net benefit for Intel. And of course, the CHIPS Act and all of the investment that we have talked about over the past few months is starting to sort of gather and maybe prevent a bit of momentum for Intel heading into the start of this year. So that will be interesting. MasterCard and Visa are always, of course, crucial for understanding spending patterns, and maybe JD providing us a little bit more detail over what was actually spent over the month of December. And it's always interesting to me, too, to sort of tie the travel spending that is apparent from both MasterCard and Visa numbers into what is being said by the airlines, and of course Southwest and American are probably likely to echo what we heard from carriers last week, that the travel boom is certainly holding on to the momentum that we saw into the last part of last year, and very likely to extend it as well.
Absolutely. Okay, let me ask you about tech earnings specifically here. They are around the corner. Are you anticipating another rough quarter? It's words, it's Monday, it's a prompter, it's fine. What are we expecting for big tech here, Martin?
You mean after this week and going into Google, Meta, and Apple the week after?
Yes, exactly. Previewing the following week a little bit, if we can.
Yeah, it's early doors. I would say that these job cuts might actually provide more of a boost to the stocks than you might anticipate, simply because they are going to have a notable impact on margins. But that margin improvement will be forward-looking as opposed to what we saw or what will be reported over the 3 months ending in December. I think Apple is still going to find it difficult to have sort of mitigated the supply chain disruptions that kept a lot of the higher end iPhones off of the shelves over the holiday period. Meta is still looking at the red ink in the metaverse division, as well as the pullback in ad spending that is holding down the revenue growth in its family of apps division, the Instagram, the WhatsApp, and of course the mainstream Facebook. And Google, of course, has essentially told us with their job cuts that they can't imagine there being a strong rebound in ad spending, and that is probably going to be reflected in what we hear out of December as well. So I wouldn't necessarily say that the narratives will be strong from the tech companies, but I think the fact that they're getting their arms around costs in a way that they haven't for a number of years may placate investors. That will probably be the most interesting sort of push-pull, if you will, JD. How will investors react to what I think is going to be a muted narrative against the cost-cutting measures that they've already put in place and perhaps plan to accelerate in the months ahead?
Yeah. Of the 56 companies that have reported so far, 64% have topped Wall Street's estimates. Martin, is the earnings season shaping up to be a bit better than maybe many would have anticipated? What's going on there based on those numbers, or is that not much of a surprise?
No, only a tiny bit better, JD. Essentially, that percentage matches the long-term average. So we're right about where we should be. But it trails quite notably the average that we've seen, at least at this point, over the past 4 quarters. If we were to look at the past 4 quarters, the beat rate is about 75%. So we're down in that 65% range. And it is early on, so we have lots to play for over the next 5 to 10 trading days as a result. But we're a little bit behind the 8 ball, and as a result, we have seen the expectation for profit growth eroding at the same time. This time last week, the anticipation was for earnings to fall about 2.2% from last year's levels. That's fourth quarter to fourth quarter. The expectation now is that's going to be down about 2.9%. And if you strip away energy sector, which is too volatile and is best to look at on a standalone basis, that decline is going to be about 7.3%. So it may end up being a little bit weaker than we anticipated. But ultimately, JD, I think that has largely been priced in. What we are really focused on now, or at least I think investors are going to be focused on, is the forward projections from all of these companies. That's why the tech narrative will be exceedingly important. And what we see and hear from CEOs of these industrial companies, healthcare companies, car makers, airlines, and all the rest of it about consumer and business demand in the coming months will be the most crucial takeaway from the season itself.
Absolutely. Data from Refinitiv, finally on this point, suggests that collective S&P 500 earnings will fall nearly 3% from last year. Do we have any historical sense? Is that largely right in line with average, or are we just dealing with a pretty unique set, which I know we are, of economic conditions otherwise that might kind of skew that annual number?
No, I mean they're hard to compare to one another because there's so much seasonality in it. It's not sort of useful to compare a fourth quarter to a second, for that matter, and first quarter tends to be weaker than some of the others depending on the sector that you're in. So a 2.9% decline, I think, is larger than we've seen over the past couple of years, but not outsized to the point that it should be terribly worrying, particularly if we see a modest rebound, at least in the comparative gain for the first quarter. And by that, I mean we're likely to be higher on collective S&P 500 profits for the first quarter when we compare it to the first quarter of 2022.
All right, time now for our rapid fire section. Onward we go. First up, Salesforce getting a big boost from Elliott Management. Is Salesforce getting a big boost from Elliott Management? What's up there?
Well, the stock was up in pre-market trading, but some of the gains have faded since the start. Essentially, Elliott Management, which of course is one of the most famous activist investors in the world, has built a significant stake. They haven't said exactly what it is, and they haven't said exactly what they want from Salesforce. But they are the second significant activist investor that's come into the stock in the past 4 or 5 months. So that probably means there's going to be big changes from Mark Benioff, who's the standalone CEO there, and potentially even a proxy fight for a seat on the board, even though neither company has said exactly what it wants from Salesforce at this stage.
All right, next up, number 2 is AMD's upgrade signaling a sector reset. What should we know?
This feels really interesting. Barclays upgraded AMD to overweight. They also boosted their price target by about $15 to $85 a share. Barclays had notes out on a bunch of other chip makers as well, but AMD was the most significant of the movers. Essentially, what they've said was that companies that have cut their profit forecasts and their revenue forecasts over the past 5 to 6 months are now in a good position from a value perspective. And as a result, that's why we're seeing the bump in the stock. The Philadelphia Semiconductors Index, which has the ticker SOX, is also up about 7% over the past 5 to 7 days. So investors are absolutely seeing value in the chip space, and it'll be interesting to see what these companies are saying about demand in the first half of this year.
All right, very nice. And fourth and finally, oh boy. All right,
you don't want to talk about
Conference
this.
Championship games are set. Yeah, okay, good. Who you got, Martin? Oh boy.
You know, I find myself increasingly impressed by San Francisco. They really seem to have good balance on both sides of the ball. They play with a great deal of poise, particularly with such a young player in a key position, and they just seem like a team that has tremendous momentum at the moment. Obviously, Kansas City suffering potentially from the high ankle sprain for Patrick Mahomes. That could impact their chances against Cincinnati. And there is still the shoulder issue with Jalen Hurts at Philadelphia. So if you were to ask me today where I would put my money, and I'm not a gambling man, I would probably put it on San Francisco. There's just something about that team at the moment.
Yeah, absolutely. Brock Purdy's playing great. We had great seasons, you and I, for our beloved squads, kind of. It's fun to get here, and now we can just sit back and watch objectively and just say, all right, I hope they all have fun. I like that too. I think I got to go San Francisco. You know what I mean? It's also, it's the idea of choosing for the Mr. Irrelevant to go all the way, right? I mean, that is such an incredible turnaround story, and you sit there during his draft last year, and he goes, oh yeah, one day I'm going to be an NFL starting quarterback, and usually anyone in that position says so, and then he does, and he just keeps on winning. It's amazing to watch. It's going to be a great weekend of games, right?
Yeah, I absolutely agree with you, JD. It's interesting, the parallel to someone like Tom Brady, who was ultimately incredibly talented, but a very late round pick. And then all he did was go on to have the most magnificent career, probably you could say, in just about any professional sport. I have no idea whether this is the fate that awaits Brock Purdy, but there is some really interesting sort of parallels in the way that he manages the game, executes the way that the coaches want him, and doesn't do any more than he is tasked with, and as a result gets these sort of incredible achievements along the way. It's been fun to watch.
You know what, Martin, I was so excited to talk about the San Francisco 49ers that I made a pretty big mistake, and I actually missed one that we were supposed to get to. Number 3 on our rapid fire, Spotify. This is important.
Oh, gosh.
And I don't mean to I know, my goodness, and I don't mean to go from something lighthearted to something serious, but this is an important one. I do want to make sure, let's end the show here the right way. Spotify announcing more layoffs, or announcing layoffs, continuation of the story that we've covered. What stands out to you here is the tech space as we're watching that more and more?
Yeah, I think a lot of tech companies are using the announcements from their larger rivals to justify cost cutting and headcount reduction at the same time. So Spotify can find itself in this situation and essentially say, look, everybody else is doing it, and it's jobs lost. Again, we are hopeful that people in the tech space can find alternative employment, and the suggestion seems to be that they can. But you would imagine a lot of other tech companies are going to use this as cover to manage their cost base and, unfortunately, get rid of a lot of people along the way. So I shouldn't imagine that this Spotify decision is going to be the end of the headlines that we're seeing in this respect.
All right, absolutely. The great Martin Baccardax, thank you for joining us to help get the week kicked off the right way. We'll see you soon. Thanks, Martin.
Thanks, JD.
All right, folks, that is going to do it for The Street today on this Monday. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.